Welcome to the daily update, where I'll go over the action in the market for Friday, January 3rd, and we'll see how things look for Monday, January 6th. Well, we had a nice little bounce. Unfortunately, at this point, it looks like a dead cat bounce. It hasn't turned anything back positive. It's just worked off some of the short-term oversold condition that we had been seeing, which is very common when the longer-term trend is still positive. We can often go through times when we have a counter trend down, and that doesn't tend to last very long. Now, it still hasn't gone away, but at least we've worked off some of these extreme readings that we have been seeing. So we're still negative in the short and intermediate term. So we kind of treat this as just a recovery bounce at this point. Now, can the market build on this and go up? Of course. Next week, you're probably going to see folks coming back. The holidays are now over. The market will be closed on Thursday for a state funeral for President Carter. But other than that, folks are pretty much back to work, and we should see volume start to pick up. Now we'll have to see how is the market going to react to that. Then on Friday, we're going to get the employment situation report, a major economic report every month that will really adjust things as well. Okay, let's go back and talk about what happened and then look at some charts. We did have a gap higher open and we were able to get back above 5,900. So that's encouraging, but it's more psychological than anything. And then we chopped our way up above R1 at 59.26. Then prices climbed and hit resistance at 59.50. We're also still hitting the 50 period moving averages, and I'll show you that chart. We're going to have to get through that on an intraday basis and then on a closing basis to turn the intermediate term trend back to looking more positive. And we ended up closing slightly off of the high. We were up 1.26%, excuse me, on below average volume still. Now, we had had 5 down days in a row, and that's pretty significant, especially during a time when there should be positive seasonality. So that's why we're a little bit suspect of the bounce that we saw on Friday. It really hasn't changed the climate, but it is showing some improvement. So we are still negative in the short and intermediate term, positive in the long term. Interest rates keep going up. We're at 4.6% now with the 10-year yield. Didn't seem to matter in Friday's session, but at some point, anytime right now anyway, the 4.5 level seems to be where the market starts to get nervous about that. And there's nothing necessarily magical about the 4.5 level. They're quite a bit higher than the market would like. But a lot of the forecasts that I've seen, that was the higher end of a lot of these forecasts were 4.5%. And now that we're getting even above that, that's when the market's like, okay, we were willing to go to the 4.5 level, and now that we're even going above that, we're getting a little more concerned about things. Keeping an eye on geopolitical things now in the upcoming week, because this is a state funeral. There's going to be folks from all over the world all congregated in one place at the same time. A huge security issue with all of that, but we'll just hope that that comes and goes and respects are paid and it's just kind of left at that. Okay, so the Santa Claus rally period has actually ended up seeing a decline of 0.5%, not unlike what we saw a year ago. And we had 2024 be one of the best years that we've seen in quite a while since 2023, because that was a very good year too. So now comes the focus to January, the January effect. If January is up, the market is really likely. It's the probability is that it will follow whatever happens in January. Of course, we're not going to know that till the end of January, but we'll just keep that in the back of our mind for right now. We're still below the 50-day moving average of around 59.44 with the 50-day moving average with the S&P, and interest rates are still going up. As I said, the mega caps had a pretty good day. And we still have this confirmed Hindenburg Omen. Around the middle of the month or so is when that may fall off the books if it doesn't have another confirmation signal. Of course, the perma bears are already treating this like a done deal. We wait for the initial signal, then the confirmation, and then we just see are there more confirmations, and then start to look at the technical picture, which has gone from positive to negative. So you can take that into account. What we're wondering, are we seeing a real shift over to a more negative, bigger picture type of climate? You could say that, but it's too early to tell at this point. We have to look at the long-term trend for that. Now, on the short-term side of things, we only have our slope oscillator. All of this list was pretty long when I did Friday's video. All of those other short-term indicators have worked off. Now, you could say, all right, maybe we're getting set to go higher, and that is completely possible. Or maybe we're working off this oversold condition before we resume going down. That 50-day moving average is kind of a big deal. We're going to need to clear that for things to look a little more positive. And in the meantime, the 20-period moving averages are coming down. So, and I'll show you the chart. And we just have the PMO studies in the intermediate term. This list was a little bit longer, but some of the areas are improving enough. We're actually seeing a little bit more improvement across the broader market. The NYSE is looking a little bit better right now than the S&P 500. And no change to the scenario. We'll see if something like that happens, especially at the latter part of this week. We're going to be getting a lot of employment data. And is that still going to justify the Fed pausing their rate cuts right now and increasing their inflation outlook? The dollar was down. That helped stocks, but interest rates keep going up. We're at 4.6%, where we had been at 4.58%. Sentiment is still negative, even though it ticked up. We were not one notch away from 25. That's when we get extreme negative, and we use it as a contrarian indicator. So we did improve there. We're coming in at 32. We're still negative with our trend. The ADX is still above its moving average. The red line's still on top. We're still above 20. So that still suggests a strengthening trend that is negative. And with the update, the bias is positive. I'm still keeping the momentum at negative because we had 5 down days in a row. And I usually take the last 2, 3, 4, 5, 6 days or so together. All right. We had the ISM manufacturing index came in under 50 at 49.3. When we're under 50, that shows contraction. But it is higher than the 48.5 they thought was going to come out. And it's also up from the 48.4 that we saw last time. So even though it's below 50, it is showing some improvement that way. Here is some charts that go with that economic report where we have the total. That's the headline number here. And blue line, a little hard to see because the orders, the yellow line, they're coming down. But the takeaway here is this 50 level, and we're below 50 with both. So that's showing contraction. Then prices are coming down a little bit where deliveries are going up. So that's actually a little bit better there. And then exports are coming down where imports are going up. That's probably a little more negative. When you have a really strong economy, you like to send products out more than you want to bring products in. And then here's just the change over time where we're still under this 50 level when we read all of these previous readings together. And we've been under this for quite a while. Okay, then looking historical length of recessions and market declines. This has got too much information on it to really be all that useful. This just talks about different times going back to 1873. Of course, all of you remember that recession and how bad it was. And then all through time and how long the recession lasted. And then what did the market do during that time? So you see nothing but red here. If we do go into a recession, that's going to be negative for the market. So that's why we keep an eye on this. And we're still looking at things that are remaining positive. Now, a lot of the employment charts will be updated after the end of the upcoming week. And we get a lot of data from that because that's part of the Fed mandate is to produce an environment of full employment so that everybody that wants a job has a job. And if that starts to really taper off, That's one of the measures used in a recession. So, but we don't know that yet. We could improve. It could be weaker than expected. But I'm kind of pausing here on purpose now in case you want to kind of look over this chart just to see how it looks. Long-term asset returns, and this is really no surprise here. This just shows equities or stocks. They're the ones that tend to return the best, where bonds, even though they've been under pressure the last few years, they return a lot less. And then cash, good old savings accounts. Okay, then 2024 sector ETF flows, a lot of money going into financials, and they're still remaining strong. They've been pulling back with everything else lately, but they're still in a longer term uptrend, and we keep an eye on that. If the financial sector is healthy, then the stock market tends to be healthy. Then we can focus more on things like tech and discretionary and all the other interactions that go on. And then we see a lot going into industrials, which have been under pressure lately, and then tech. A lot of money going into tech. Okay, then investors sold gold ETFs for the fourth straight year in 2024. Gold's been hitting all-time highs here, and yet we're seeing money coming out of the GLD, which is the gold ETF. That's the main one that I focus on. That was one of the first ETFs too, and that was kind of a big deal when that became available. The euro hits the weakest level versus the dollar in over 2 years. Again, this is great if you want to go on a trip to Europe. You're going to get a pretty good exchange rate, but that means the dollar is stronger, and that is what's pressuring stocks right now. Then the financial conditions indices here, or indexes if you're an American, coming down here, and that tends to be more positive when we see this loosening, but it has been going back up in some readings here, and that's pressuring things. When things get a little bit tighter, there's not as much money that can flow into the stock market. And then where do you see the 10-year Treasury yield by the end of 2025? People love to do predictions and they love to tell predictions and listen to other people's predictions. And they're almost always wrong, but we still do it anyway. The majority of folks think we're going to be at 4.25 to 4.5, and we're already above that right now. And that's what's kind of freaking the market out because they thought 4.5 was the upper end of things. Okay, the S&P posts 5 days of losses, not on Friday, but this was done before Friday's session on this chart. We were waiting to see if there was a sixth, but nope, we didn't see that this time. And then this is kind of an interesting chart, and not so much the chart itself. The takeaway is what's in the text here. It says the broader liquidity environment in the U.S. is set to change dramatically in 2025 as a large chunk of the corporate debt issued, companies that borrow money or put out bonds, in 2020 and 2021, it comes due for rollover. And when they roll this over, it's going to be at much higher rates because they were a lot lower in 2020. They were at zero in 2020, and for a large part of 2021, in fact, for most of 2021, it's 2022 when they started to really change things there. And so this is really going to have an impact. And this is money that could be going to earnings and could be going to profits. Now it's going to be going to interest. And so this is going to change the landscape of things. All right, let's look at the intraday chart. Positive all the way through, didn't even come back down and fill the gap. We did have a higher open here, a gap higher, and we just really chopped our way. I think a lot of people were a little bit gun shy because we had that positive open on Thursday and then boom, everything just reversed. So you had a lot of people that were kind of nervous right here at the open, and we just chopped our way up a little bit above R1, and then we were able to break up above R1, and then this 59.50 level acted as overhead resistance, which is also a little bit above the 50-day moving average. So here, and it's a psychological level. It's a round number. And then we trailed off a little bit of that going into the close. And so we were actually looking a little weaker here with the futures, but then they started to come back. And then that led us over into the cash session and closing things down a little bit up here and as things get shut down for the weekend. This is still looking positive, and it has been looking positive. The intraday chart between growth and value. Growth is in blue, red is in value. Value is red, growth is blue. There we go. And When the blue line is above the red line, that tends to be more positive. Yes, they are on different scales, but we can see a general, we can get a sense for the atmosphere here that growth is still holding up better than value right now. And that's what we want to see in a more positive environment. Also seeing an improvement with the growth to value ratio for the S&P intraday. And I stretched this out a little bit because I'm going back to the end of November. This is when we seem to have bottomed and we've been coming up. We've been under pressure with this ratio lately as stocks have been under pressure, but this had a nice day on Friday. So this is more under the surface, still looking pretty solid here. If this was going down as the market's going down, we would be even more negative. Okay, end of day growth was up strong, 1.74%. Value was up, but only up about a percent less. It was up more for the mid caps and also up more for the small caps. So we're seeing some improvement, not in the index. We're just chopping sideways with the small caps, but we're seeing an improvement with the growth to value ratio here after it was really trailing off. It did bounce back up. A very similar thing here with the mid caps, going sideways with the index, but the ratios continue to go up and bouncing back up and still in a longer term uptrend with the S&P. And bouncing back up after setting a really high reading here with this ratio between growth and value with a couple of ETFs, we are bouncing back up now. And discretionary to staples still holding up fairly well after it had been declining. Large cap growth came down to its 50-day moving average and has bounced up off of that. And there's some 50-day moving averages that are coming into play as possible support areas. Now we're below it with the S&P, but we're not here with the large caps. And for the Nasdaq and Nasdaq 100, they could be providing support, and I'll show those charts later. So we are coming up a little bit there. As far as our trend, we are still negative. We're the dark black line is the ADX. That's the main indicator. And then I put a moving average on top of that to give us some context. We're still above the moving average. That means a strengthening trend and we're above 20. So that also means we are trending. And we're negative because the red line is above the green line. Even though the red line came down, the green line didn't really go up all that much. And in the short term, we're also seeing a negative trend with the red line above the green line, and it's getting stronger above 20. We still are below average with volume, not a real surprise with the holidays and everything. We finally got a reading from the Investors Intelligence. Hadn't had one of those in a while. We came in at 3, so we're well off of the reading that we saw in the previous time. And when we get above 3, that's when we get a little bit cautious here because people are too bullish at that point. Coming back down to 3, the context is that this has been declining. So actually, we're seeing sentiment as measured by this is coming down. We're still getting a high reading with the Ulcer Index. It continues to go up, which is a sentiment gauge. We came down with the VIX. We're a little bit below the moving averages here on the line chart and dropping a bit below the moving averages here with the bar chart. Also, when the VIX comes down, the VIX of the VIX also comes down. And after it looked like we were starting to go back up was the momentum of the VIX. With the up day, now we're starting to turn back down, but we're right back down to the moving average yet. Still, at this point, coming down, but still in the red area here with the skew index. Whatever move the market is anticipating, maybe it's an up move because we came down with this in Friday's session. A lot of people are buying calls, hoping that things are going to skyrocket up and they're still expecting that to happen. Okay, seeing some contradiction here. We went up with this fear gauge and we came down with the other fear gauge. Not a big change here with the risk on to risk off ratio. We were really going up, being more risk on, and that's when the market's going up. We've been chopping around, even dropping back a little bit lately, but that did improve on Friday. And after really spiking up with the equity put call ratio daily chart on Thursday, it really came down after Friday. So we're getting a mixed picture here, turning down a little bit with our 5-day chart. And I'm including the longer term version of this because when we get below this green line, quite often that can mark a top in the market. We're just not sure where this bottoms out, but we are below the green line. And we're still going up with the 10-day because it takes longer to calculate itself and not really seeing an increase in fear here with the volatility risk premium came down a little bit after coming up to the lower end of the band. Not much of an improvement, but an improvement still with the advanced decline line. Now we look under the surface. I call these market internals here. Turning back up slightly based on price and volume, still above the moving average. So we're still looking good longer term, but we need to see more follow through, not just a 1 day wonder here of an improvement. And not really seeing an improvement here. Another internal measure. There were more new lows generated on Friday than new highs. So we're still going down with the 5 day. We're trying to bottom out here with the 10 day. And improving, but still, well, looking a little more positive with the accumulation distribution. We've crossed slightly back above the moving average. But this isn't all that I wouldn't read too much into this because you have to look really close just to see what's happening. We've been flatlining with this quite a bit lately. Now I have the boom indicator down below, and that did bounce up here, but this is looking a little more positive. You can barely see where the blue line's above the red line, but it's not really doing much. It's not really moving up or down with any conviction currently. And we did see an improvement, but we're still negative with our advanced decline ratios. And this breaks it out on price and volume where we are bouncing back up, but still below zero. This actually got worse. The Chaikin money flow continues to decline and the red line's going down. So this smart money indicator is even more negative, even after the advance that we saw on Friday. And we're ticking back up and turning slightly positive with the Chaikin oscillator. So now we're getting a mixed picture. We're slightly positive with the accumulation distribution, more negative with the Chaikin money flow, and turning back to positive with the Chaikin oscillator. So it's like small, medium, or large. Take your pick. And we're coming down a little bit with the red line and going up with the green line, but the red line's still above the green line. So the vortex is still negative. A little bit of a tick up here with the cumulative advanced decline line for the S&P based on price and a bit of a tick up based on volume. This is more of an improvement though. The 10-day simple moving average of the advancers minus the decliners. We saw enough of a move up here to actually cross above zero. That's turning positive and saw a bit of a tick up here. The S&P went up and the NYSE advanced decline line is actually going back up as well. This is still negative, even though it improved slightly. The 10-day average of the highs and lows for the S&P continues to be way below 50 and really hasn't been able to start coming back up yet. And the cumulative advanced decline line for the NYSE, we're above the moving average. That's positive. Ticking up here, but still below the moving average with the regular NYSE advanced decline line, as well as this other NYSE advanced decline line. But a little bit of an improvement there. And we turn back up with common stock based on price and volume. And we're improving here with the advanced decline line studies, but we're still below the moving averages with all the indexes. We are improving here with the 5 day highs minus the lows, and taking a moving average of that across the broad market. We're still negative, but we're coming up after we had been a lot more negative. This is no longer extreme negative, and this is another area we've been watching, especially in the short term. The stocks in the S&P above their 20-period moving averages. We had come down below this green line, and we're just starting to come back up now. Now, we still have a long ways to go just to get back to 50, but this could be a start, or this could be just working off getting that extreme negative reading before we're getting set to go back down again. So we're keeping an eye on this study. We need to get up to this 70 level here. 50 is where I consider it to be turning positive. When we get up to 70, that's meaning really solid short-term strength. So we'll be waiting to see if that happens. But we've been waiting for quite a while now. Bouncing back up after getting extreme with those stocks above their 50-period moving average. And with the 100-period moving average seeing a bounce there. We never have gone negative with the 200 study. We're still well above 50. Well, not well above. We're at 56. But we're above 50. Okay, we can finally see some of the chart here now that the pivot points have shifted off a little bit to the right, but we're coming back up and we're having a really difficult time getting above the 50-day moving average. Once we broke below that, that has become overhead resistance repeatedly now. And we're no longer extreme with the 20-period exponential moving average on the S&P, turning back up with the 50, flat to going up slightly with the 200. No longer extreme with the Stochh RSI. The Williams percent R is bouncing back up. The CCI 14, which never went extreme, it's bouncing back up. The CCI 20, which did go extreme, is also bouncing back up. And we're no longer extreme with the short-term stochastic. And I say that because that's a further subdivision of the short-term time frame. Short-term, intermediate short-term, long short-term. And we're turning back up with the intermediate term. We're still declining with the long-term stochastic. And turning slightly positive with the force index. Really hard to see that, but it has come in green. The condition of the short-term trend is still vulnerable. We're still going down with the blue line and the green line, even though we're coming back up to these lines. We need to get above them, stay above them, and see the lines turn back up. We're still below the simple and exponential moving averages here. So that's why I declare the short-term trend as negative. And we're coming up, but we're still below the midpoint with our standard deviations chart. Bouncing up, but still negative with the balance of power. S- Still showing the dark purple here, deep purple. A little smoke on the water look here, or highway star, or whatever one. Or burn, there we go. That's what the perma bears think. But this is still giving us a negative signal. And also coming back up to the midpoint, bouncing off of this red lowest low line, but we haven't crossed above the midpoint yet. And we are seeing a little improvement here. The TTM squeeze has gone from the darker red to the lighter red. We see how we're just continually bumping into that 50-day moving average. And we're slowing down a little bit with the speed. That's what standard deviation measures. We're coming back down closer to the moving average. We're still negative, and we ticked up a little bit with the ease of movement. And we're flat after going negative with the Arun indicator. Improving here with the McClellan oscillator for the S&P, but still below zero. So we continue to decline based on price. We're turning up just a little bit based on volume, and sometimes volume will lead price. So this could be positive, but we saw that before and it led to nothing. We were starting to go back up based on volume. We flattened out based on price and then rolled over with both. So we want to respect this and look at this and know about this, but not try to front run it until we get more proof that things are turning back positive. This is where we are looking a little more positive. We've crossed back above zero with the NYSE McClellan oscillator. That's actually turned positive now, and it's going to be really hard to see, but we're barely ticking back up with the summation index based on price, and it's really hard to see there. We could be ticking up based on volume as well. We're still negative here and declining with the Swenlin trading oscillator. That didn't suggest that Friday's move really changed anything. We're below zero based on price and volume. We're slowing down, but we're still declining. Momentum is still negative. The PMO is going down. We're going down based on price and volume. We're no longer extreme with the PMOs that are rising. That actually bounced after being extreme negative. We're turning back up, but still extreme negative with the buy signals. That's why this is still on the list. But when we look at the PMOs above zero, that continues to decline. And we're turning up a little bit here with the short-term oscillator, but we're still below this red line, extreme negative, and below the moving average. The MACD continues to go down. It's like nothing happened on Friday, according to it. So we're still negative in the short, intermediate, and long term with momentum. Copy curve, turning up a little bit, but still negative. And turning up a little bit with the Sean trend meter, but still more in this yellowish area. Coming up, it's still negative with the money flow. Ticking up and just barely below 50 with the ultimate oscillator. Ticking up, it's still above the moving average with on-balance volume. Coming up, it's still below 50 with the RSI 14 and the RSI 9. So can you see why I'm saying there's an improvement here, but everything is still negative? And we're still, excuse me, we're still negative with the parabolic SAR. We're going to have to see a bigger upthrust, especially getting back above these highs that we've set over the last few sessions at the 50-day moving average. And we've gone from negative to neutral, though, with the Elder's Impulse system for the S&P. This is studying the intermediate term trend based on 50 periods. We're coming up, but these lines move a lot faster, so we're a lot further away from them. But we're still coming down with the blue line and the red line. This is the one that we're looking at. You can see we've had numerous days now where this has been the high. Sometimes it's the exponential version, sometimes it's the simple version, but that's pretty much where we're topping out. we're going to have to get back above that because we have more of a negative leaning chart right now since we set a high, came down, went up, set a lower high, came down here and we broke below this low on Thursday. And that's making things look a little more negative. To turn it back positive, one step is going to be to get this back above the 50-day moving averages. So we're still below the 20s. And when I said they're rolling over, you can see how they're coming down and getting kind of close to the 50s. And we ticked up a little, but not very much with the bullish percent index. So an improvement here, but still negative. Ticking up just barely with the NYSE bullish percent index and showing a little bit more strength. The mega caps had a pretty good day, but we're still below 50 with the NASDAQ 100 bullish percent index. And coming out of the cloud now, but we still see that the blue line is below the red line. That's more short-term negative. We are going back up with the green line. But this area, this Ichimoku cloud here, is providing some kind of support, at least for right now. And this is kind of where things started. We came all the way up to the upper end of this trend channel. We were not able to break above that, and we've been down below it ever since. So looking a little more positive with the Heikin Ashi, we have an open candle here after a lot of dark ones. And we're negative, but pointing up with the Kegi chart. We're back to positive with the Renko chart, but we're still negative with the three-line break. So we're getting a mixed picture there. And bouncing up and going back above this blue line with the 150 simple moving average. This is longer term and just kind of chopping around, but still above this blue line with the 200-day moving average. And this is what another thing that we're watching for right now to see. Now, Friday's data is not included in this chart. Did we have enough of an upward move? And this is based on the NYSE, which is actually holding up a little bit better right now. Are we going to be able to get up to this red line? That we're just waiting to see what will happen with the ZWAG NYSE breadth thrust. And we'll see. We're negative in the short term with stocks, and we're negative across the board with bonds on all time frames. We switched back to positive with commodities in the short and intermediate term, and the dollar is still strong across all time frames. We're still negative with stocks in the short term and also still negative in the intermediate term with the mid caps. All of the sectors ended up being up with discretionary being up the most. Tesla was up just a really big percentage, and tech did well. These are two growth areas. Then down at the bottom, staples, that's more defensive. That ended up being down slightly. They're right at their 50-day moving average, which is kind of interesting. We'll have to see if we bounce up off of that. And nothing but green here. We got St. Patrick's Day going on because we had Canada doing well right off the bat. We got back above 5,900 with the S&P. And then it's kind of weird how this happened. Doesn't 19.3 come before 19.4? And the time is about the same. But we went from 19.3 to 19.4 to 19.5 to 19.6. The utilities are crossing back above 50. That's been one of the stronger areas earlier in the year, but lately has seen some weakness. So we're seeing a little bit of strength there, which is kind of a concern. If we get into a higher inflationary environment and the market's under pressure, that's often when utilities perform better. And seeing a bit of a bounce here when we compare the weighted version of the S&P 500 with the equal weight version. Coming down, well, actually, we ticked up just a little bit here. We had been coming down when we do a ratio between these two. When this is going up, that means the weighted version, the one that everybody sees, is doing better than the equal weight version. And the Dow is just kind of chopping around, even though it was up 0.8%, still below its 50-day moving average. But it has gone from negative to neutral with the Elder's Impulse system. And this is the 50-day moving averages for the NASDAQ. Notice how we came down here and we were able to close at the 50-day moving average. Right now, we're trying to bounce up off of that and actually getting a little bit above this pivot point. Is this going to be where we get some support from? Right now, we are interested in that. Can we see more follow through with this? So the NASDAQ held up a bit better. Where we've lost the 50-day moving averages with the S&P, these are holding a support with the NASDAQ and also holding a support with the NASDAQ 100. Now, we came right up to this pivot point where we're on the previous chart, we're a little bit above it. With the NASDAQ, we're right under it with the NASDAQ 100. If we can see more follow through, that would really help things. And we've gone from negative to neutral with the Elder's Impulse system for the Qs. The momentum is still negative for the NASDAQ 100. This is another area I've been pointing out. We came down to the 50-day moving average. We fell below it intraday, but on Thursday we bounced enough to come back up to it. And there have been times when this is where the market gets support from. Sometimes it's the S&P. Earlier in 2024, it was the mid caps, believe it or not. That's why we watch all these different indexes. I focus on the S&P 500, but we look at all these other indexes too, because sometimes we can get some insight. Right now, we're watching this to see if this 50-day moving average will hold, if we can bounce up more out of that. Small caps just floundering around. They were up over 1%, but they really have gone nowhere like they're supposed to. And we're seeing a bit of a bounce up here, but going sideways with the Russell 2000 small caps, going back up a little bit with the RSI, but the momentum is still negative, still below the 50 period moving average. And we're still neutral with the Elder's Impulse system for the small caps. Here are the mid caps, also floundering around, going sideways below their 50-day moving average, and still neutral with the Elder's Impulse system. The Wilshire, this could be another thing. This is a broad market measure, and we're also having a bit of trouble right now getting back above the 50-day moving average here. So if this could get above it on an intraday basis and then close above it, that would help things turn more positive. In the meantime, this should be treated as overhead resistance until proven otherwise. Also coming back up to the 50-day moving average with our total US stock ETF. So that's also overhead resistance. The financial sector just a little bit under its 50-day moving average. The FANG index holding up fairly well, never came down to its 50-day moving average. It was up 1.44%, but we're still below this shorter term trend line, which we kind of looked like we were breaking out above it, and then we came right back down into it. Apple was down 0.2%. There's some concerns. I think sales in China or something were not as strong as people were hoping, but we're still above the 50-day moving average. Amazon was up 1.8%, but still off of its highs. And Microsoft still dancing around its 50 and 200-day moving average. It was up over 1%, coming back up to its 200-day moving average. Google was up 1.25%, but also off of its highs. Meta bouncing up a little bit more off of its 50-day moving average. Nvidia was up 4.45% above its 50-day moving average. Tesla up over 8%, but still well off of its highs. That truck that exploded in Las Vegas and it goes up 8%, whatever. Okay. And then Netflix was down 0.64%, but still above its 50-day moving average. We're keeping an eye on oil because it's starting to go back up. There's some news coming out that oil shipments between was it Russia and Germany and Ukraine and all that, that's all stopping now, and that could be pushing the price of oil back up. That's mainly geopolitical, so we want to keep an eye on that. We're seeing a real fall off in the short-term correlation between US stocks and world stocks, but the longer-term correlation continues to get stronger. Semiconductors had a good day, up 2.9% with the SMH Semiconductor ETF coming above its 50-day moving average. This shows that support is holding and we're actually getting above the 50, but we're still going sideways here. As you can see, we're just coming out of the top end of the rainbow and these lines are all jumbled up with each other right now. Saw a little bit of an improvement with the semi to tech ratio, but we're just kind of at the high end of the range where we've been at. We need to see more follow through with this, but we're still negative, although we did get back above the 50-day moving average with the SOX index. Now, can we get up and clear the 200, get above these lines and have it turn back up into a golden cross? Right now, we're still dealing with a downtrend with this index. And the dollar, it was up in the 109 range. It did fall back here. I mean, this thing is just going up something fierce right now, and that's pressuring stocks too. And we're still going up with the 10-year yield, and we're coming down just a little bit here with the 10-year based on price. This is another concerning area. Home construction to 3 to 7-year bonds falling below support here, bouncing back up, but has a long ways to go to improve. And saw a little bit of an improvement here with our growth to value ratios. Now I look at some of them at the beginning of the video, and then these I look at near the end, where we're coming back up with Q's to S&P. We're bouncing off the moving average, turning back up with discretionary to S&P, but still below the moving average, and bouncing off the moving average when we look at large cap growth versus large cap value. We want to see more of that to be more positive. And we're coming back up off the moving average with the large caps, mid caps cross back above the moving average, as did the small caps. So improving, but we want to get above these and see these moving averages keep going up, not just see one day where things look better. Okay, what's our outlook? Then I've said this before, Thursday, January 9th, the market will be closed for a state funeral for President Carter. The technicals are still negative, but we are seeing some improvement. And we're going to get the S&P Global US Services PMI, the final reading. That'll come out on Monday, as well as factory orders. And then all the crazy stuff going on in the world. We'll see if the market pays attention to that. Here is the economic calendar for the upcoming week. Here's Monday that we're already talking about here. We're going to get ISM on Tuesday. We're getting jobs data on Tuesday. We're going to get the ADP employment change on Wednesday. The meeting minutes from the last FOMC meeting are going to come out. We'll have to see if there's some reaction to that. Then we're going to get, now, I'm not sure how this is all going to work because the market's going to be closed on Thursday. We're scheduled to get initial jobless claims and continuing claims, but we won't get that because everything will be closed. So I don't know if they'll be coming out on Wednesday or if they're going to come out on Friday. And then Friday is going to be the big employment report as well as consumer sentiment. And here's a look at the week too. And they still have initial jobless claims on the list here, even though it's called a national holiday because of the state funeral. Then looking at sentiment, I'm not going to go through all the top part here because most of this applies to the whole month of January. But looking at January 6th, we're neutral to negative with the Dow, where we're neutral to positive with the S&P and slightly positive with the Nasdaq. And going on how things were working out in 2024, Monday was not as strong a day, but still all the days ended up being positive in 2024. Also, we're in the first half of January, which tends to be a better performing part of the year. And then we come into the second part of January later on, which is still positive, but doesn't tend to perform as good. Small caps should be going to the moon. They're still on the launch pad. January, when it's up 58% of the time, which is not a great, advantage there. And when it is up, it's up an average of 1.1%. And this is comparing all the post-election years, the fifth year of a presidency, when the incumbent party wins, when the incumbent party loses, and then the aggregates, the blue line here. And just we're looking at all of this over here, but where we should be focusing, and it's really hard to get anything from this because we're all jumbled up. It all starts at zero at the beginning of the year. So it's not really that helpful, but this is a longer term look through the whole year. And this is a new chart here. This just says the first quarter of the first year of the presidential cycle is usually weak, and it could be. Now, it could get better, but it tends to be not one of the best performing times. Okay, we are still a little bit positive with accumulation distribution. We're negative with the Chaikin money flow, and we're back to positive with the Chaikin oscillator. So take your pick there. The advanced decline lines are still negative. We're below the moving averages. We're back to going up with the 10-day equity put call ratio chart, and we're still going down with the S&P McClellan oscillator and summation index, the parabolic SAR, the Swenlin trading oscillator, the momentum. We're improving with the bullish percent indexes for the S&P and Nasdaq 100 and looking just teeny tiny little better with the NYSE, but those are all still negative. We have a confirmed Hindenburg-Ullman. The vortex is negative. Our 20, 50, and 100 period moving average studies are negative. The ease of movement, money flow, ultimate oscillator is negative, and the momentum for the NASDAQ 100. Still a pretty long list here. Positive side, growth to value, discretionary to staples. I've been saying this over and over, but at some point that's going to have to matter. We hope that it will be in the upcoming week if we're going to turn things back more positive. And then the 5-day equity put call ratio chart is going down. which is more positive. And we're back to positive with the NYSE McClellan oscillator and just barely starting to turn back up with the summation index. We're still positive with the 200-day moving average study with the S&P, and the financial sector is still positive. And then here's an update of the Hindenburg chart. No additional. We'll have to see. Friday was kind of a big day. We'll see if some kind of spike comes out of that. All right, our conclusion, we're improving, but we're still negative. The large caps and growth, they're holding up and saw a bit of an improvement in Friday's session. What we'll be watching is support at the 50-day moving averages from the NASDAQ and NASDAQ 100. Can that hold up? Can we build off of that? In the short term, we're negative but improving. Our list is a lot shorter now. And in the intermediate term, we're improving, but we got to get above those 50-day moving averages. And in the long term, we continue to be positive. Thank you. Have a really good weekend, and I will talk to you in the next video.